Hey, what's going on, YouTube? I hope you guys are doing great. So, let me ask you guys this question. Are you struggling to spot high probability trade setups? Well, worry no more, because today I'm going to be breaking down these two powerful ICT concepts that have really been working out for me lately, and it's been really good, doing good, guys. I promise you that. So these two powerful ICT concepts are the fair value gaps and liquidity. Alright, so I hope by the end of this video you'll know exactly how to use these two tools to evaluate your trading. Alright, so yeah, let's dive straight into the video, guys. Okay, now what is liquidity? So I'm going to be focusing only on liquidity for this video, and then for the next I'm going to be doing fair value gaps. So yeah, let's start. So what is liquidity, guys? Definition. So this is a little bit of note that I had to put it here so that you guys can read it too. Right? So what is liquidity? In trading, liquidity refers to areas on the chart where traders place their stop loss orders and pending orders and are likely stacked. These areas act as magnets for the price. Liquidity often resides above these recent highs and below the recent lows, essentially where stop hands occur. Okay, so examples of this, let's go straight into this bullish market, and then we'll go for the bearish market. So for the bullish market, this is how price goes. All right, so assume price was on a downtrend and price is trying to reverse. So this is a structural form of a bearish market. So price comes down, gives us a swing low or a lower high. What is it? A low, lower low. Gives us a lower high, respects a fair value gap, lower low, lower high, lower low. Now this is where the liquidity sweep occurs. Okay, so liquidity sweep, and then a market structure shift over here comes back for the bullish fair value gap and respects it, and then expands the upside. Now this is where you enter your buy position. All right, so where will you know, or how are you going to know that this liquidity is going to be valid? When you see a sweep. All right, so this is going to be a sweep with a wick on it. You don't want to see a body closing below it. You want to see a wick, and then immediately price jumps up to shift the market structure, and then comes down to respect this bullish fair value gap. Now that's where you're going to enter your trade, and whenever you enter your trade, you want to be targeting only 1:2 risk to reward ratio for you to be safe. All right, okay, I'm going to come back. I'm going to be showing you a real chart example after this. So let's go for the bearish market. So for the bearish market, it's just likewise the same. All right, for the bearish market, we've been going up in a bullish trend. After price gives us this, respects this fair value gap, price elongates, or I don't know what to use. All right, so price gives us an expansion, all right, and gives us a sweep. Immediately the sweep price, so with a wick, all right, with a wick, you don't want to see price closing with a body. You want to see a wick, and then price immediately drops down to give us a market structure shift. Immediately price give us that. You want to see a fair value gap being respected over. You don't want to see price going all the way to the high. No, you want to see price respect this fair value gap and immediately a drop. So this is where you enter your sell position, and remember, you want to be risking 1:2 risk to reward. It depends on you. That's just, I like using 1:2 because it's kind of safe. All right, yeah, so let's go for the chart examples. All right, yeah, so now, so this was on gold. As you can see here, this was on gold, 15-minute time frame, and we want to be analyzing with that. All right, so I'm gonna just be randomly analyzing it just like that. I don't want to be editing this video too long. All right, yeah, I just want to be analyzing as simple as that. All right, okay, now over here, where do we see our liquidity sweeps? Okay, so if you see here on gold, starting from here, let's start here. All right, what has price been doing? Price was in a bullish trend, and then price drops down over here. All right, so when price drops down over here, you can see that price has been giving us a bearish market, right? Lower high, lower high, high, lower high, sorry, lower low, lower high, lower low, lower high, lower low, lower high. You wanna see price doing this, right? Lower high, lower low, lower high, and then what is this? This is the sweep that I was talking about. Now you wanna see this, right? So this was the previous swing low. Price drops down to this low, and then it sweeps, right? You see this wick. Now that confirms you that's a liquidity sweep. So you wanna mark that, and then the next thing that you wanna see is a displacement. Remember, price drops down, gives us this, and then sweep, displacement above this high, the body close, then comes for the bullish fair value gap, and then you want to see an expansion. Okay, so this was the liquidity sweep, and then price goes up. So you want to see price close above this high. There was this high. Okay, so what do you see? You see a bullish engulfing, right? A bullish engulfing that closes above, bullish engulfing candles that closes above this high. So this become our market structure shift. Okay, the next thing that you're gonna be waiting for is price to fill a fair value gap. So why is the fair value gap that you spot here? There was these two fair value gaps over here. There was these two fair value gaps here. So there was this fair value gap. There was another bullish. You want to be spotting bullish fair value gaps. Bullish fair value gap over there. There was another one here. Okay, so how do you know which fair value gap is going to be valid? So I'm going to be doing another video on fair value gaps, but for now let me just go past it. All right, yeah, so this is going to be a bullish fair value gap. Why? This one over here, because it was responsible for price breaking this recent high that was here, right? There was a low, a lower low, lower, higher low, higher high, higher low, and then an expansion. So price closes above this high. So you want to see price come back for this fair value gap and respect it before price goes up. All right, so that's like our third confirmation, a sweep, and then price displaces a market structure shift, and then you want to see price come back for the fair value gap, and that's where you want to enter the price. So where do we enter the price? This is where we go long over here. Price respects this sweep with this huge wick over here. This is where you want to enter the price. Place your stop loss. You're gonna place your stop loss before below the fair value gap, and then you go for 1:2 risk to reward. So this 1:2. If you go, okay, let's see. Yeah, that's how it works. Very easy. Okay, let's do another example. Where's another one? Okay, over here, what do you see? Price has been long. So this is just another bullish example. So price has been longing, going up until price drops down. So it gave us this move. Now it's dropping. So before this price goes up, price drops down and give us a liquidity sweep. So price drops and give us a sweep over here. It doesn't close with a body, it closes with a wick. Remember that. So price give us a sweep, and then immediately give us a sweep. You want to see a displacement above the highs. All right, so this was our high before the sweep. So this is what we're going to mark, and we mark this our market structure shift. Okay, and then the next thing you do, you mark out the fair value gap. So if I mark out this fair value gap over here that was formed, you see that price had already mitigated this fair value gap and expand. So you want to see an unmitigated and unfiltered fair value gap. That's price that price is going to likely to respect. So this over here was another fair value gap. You see that, right? There was a fair value gap over here. So this is going to be our valid fair value gap. And as you can see, price did drop to that point, and this is where we take our long entry. Place your stop loss below here, this loss, and go for 1:2 like that, and there we go. Okay, so another example you can do over here is another example. Like I told you guys, this strategy always works out. Like You can never miss this setup. All right, it always is there in the market, man. All right, so when price drops, all right, we're still in the bullish, right? Still in the bullish market bias. So price drops give us this huge move, right? So if you see here, price had already given us a what? A break of structure over there. So price break structure, right? And then it gave us a fair value gap that wasn't respected. So this fair value gap wasn't mitigated yet, right? And below this, what do you see here? There was some lows, right? There was some swing lows over there. So we call this inducement, okay? And if you see here, after price goes up to change the market structure, right? To break structure over here, price drops down towards this low inducement over here, these lows over here, and give us a liquidity sweep over here with this huge candle. And as it gave us the liquidity, it respects this fair value gap. Remember, you don't want to see price close below these lows, and that's exactly what price does. It doesn't close below that. It didn't even got to that point. It just reversed immediately. It filled this gap with this huge wick. So I think this was news or something. Okay, and after that, so this, okay, so in terms of entry, after seeing this a sweep respect of the fair value gap, you don't want to be entering your entry over here. So you want to be trading after the news, right? So it depends on how you trade. For my case, I don't trade news, I trade after the news. So after price gave us a sweep, I want to see another confirmation that price is going to go up. After that, it's not going to drop and fill this again, because most of the time price comes back to fill the imbalances. So after seeing this bullish a green candle, you can tell that price, this green candle closes above this swing high that was here. So I call this a break of structure. Now this, after immediately this price closes, this is where I enter my entry. This beginning of this bullish green candle over there. So this is where I'll be longing my position, and I'll be placing my stop loss at this low over here. I don't want to see price come back to this point, and then I go for 1:2 risk to reward ratio. Okay, so this is 1:2. There we go. You end up in profit, and immediately price does that, it drops, and I hope you can see another liquidity sweep. Okay, so like I said, this strategy always work out. You will never ever like miss this. It always gives you like an opportunity to get into it. So in a bit, okay, so this is gonna be a bearish example. This is a bearish example. So in a bearish example, price give us a stop hunt. A stop hunt is when you see price goes up, breaks with this bullish blue candle, and then immediately it drops with another black or red candlestick inside. That becomes our stop hunt. I'll mark this. Okay, let me mark it. A liquidity sweep is the same thing. All right, liquidity sweep. So a liquidity sweep, you want to see the next thing you want to see. I hope I'm not rushing. So the next thing you want to see is a displacement, a close below these lows, and there we have it. Right, so this become our market structure shift, and then the next thing you want to see is a bearish fair value gap, which is over here. There was a bearish fair value gap over here, and what did price do? Price came up and filled this gap, and that is where you want to enter your short position. Let's assume even here. Okay, so you want to be placing your stop loss above here, and then you want to go for 1:2 risk to reward. Yeah, and that's how it goes. Okay, yeah, it's just a very simple strategy, guys. Okay, even here, even what's happening right now on gold. So this is on Sunday. This is on 19. Today is on 19 January. Okay, so if you see here, there was another setup like that, another bearish example. So price gave us this. Is that valid? Okay, let's use this one. So there was some lows, highs that were lying. So this was inducement. There was some pool of liquidity that was still lying over here, and we wanted to see a sweep, right? So after price gave us this market structure shift, I'm not seeing any liquidity here. So price dropped, right? And then when it dropped, you can see that price later on it came back and then it gave us a sweep over here. And then after the sweep, what do you want to see? Price closing below a low. So this was the liquidity. This was liquidity pool was lying. Okay, and then after that, so let me mark this for you on the X. After that, what do you want to see? A displacement. And over here we had a lower low, lower high, lower, Jesus Christ, lower low, lower high, lower low. Okay, it's very confusing. So this become our market structure shift, and then the next thing you want to see is a bearish fair value gap. Over here we have a bearish fair value gap. What does price do? It fills the fair value gap immediately, and that's where you are supposed to be shorting gold. Place your stop loss above this high, then go for our risk to reward, which is 1:2. You see, I didn't take this trade personally. Okay, I wasn't trading gold that time. Anyway, that's another story. So you see, the liquidity concept is just straightforward. It's very easy. A combination of liquidity and fair value gap, bro, you are done. These are like the secret ICT setups for you to completely be a profitable trader. Okay, yeah, so I wanted to make this video very short, and my next video I'm gonna be just doing a fair value gap, how to trade fair value gap with liquidity. Just the same thing, but it's gonna be more focused on fair value gaps. So if you didn't understand the liquidity concept, I hope I'm going to catch up with you guys. Maybe I'll make another video or something explaining much more better. Yeah, so let me end this video, guys. Before I end this video, please like and subscribe to my YouTube channel and leave a like and a comment. Alright, yeah, so peace out, guys. Peace out.